Good morning from London. I'm Anna Edwards alongside Guy Johnson and Kriti Gupta. We're an hour away from the opening trade. Here's what you need to know. Treasuries get a jolt from soft US jobs data, further supporting the case for perhaps a supersized Fed cut. A rebound in stocks loses steam. Japanese real wages rise for the second consecutive month, keeping the BOJ on track for another potential rate hike later this year. And Bloomberg understands that OPEC Plus is close to agreeing to delay a planned increase in output as Brent crude trades near a 14-month low.
In the meantime, a quick check on these markets. When you look at the futures picture, the doom and gloom, I'm going to try to get that right, is continuing, very not to the same panic kind of margins that we saw earlier in the week. Eurostoxx 50 futures down 0.2%, a similar margin on the FTSE 100 as well. To me, my eye goes straight to the bond FX market. If there's a case for normalization, it's showing up in the 2s, 10s, which is disinverting. We're going to find the right term for that, but that is a crucial metric that we're going to keep an eye on. Having ripple effects into the dollar, which is pushing strength into the Japanese yen, 143.42 on that currency pair. The countdown to the opening trade starts right now.
Thursday the 5th, good morning, welcome to the programme. So let's talk about the US data. The US curve can't make up its mind whether it wants to be inverted or disinverted. We're kind of on a kind of flat line at the moment, waiting to see what's going to happen there. But a quick recap of the data. ISM manufacturing, bad. You get the JOLTS number, bad. The Beige Book, normally we don't care about the Beige Book, but pretty bad. Now we get ADP, now we get into the payrolls number. I think the end of the week is going to be the ultimate decider. But, Kriti, everybody's watching this bond market story incredibly carefully, trying to work out what is happening here and what the real signal is in terms of where we're going with the Fed.
We were waiting for this payrolls number. We're still counting down to this payrolls number. And yet, it feels like the most exciting part of this week happened in the last 24 hours, which is that the Fed's Beige Book has actually been gloomier and doomier than what we saw in 08.
When did you last care about the Beige Book?
Apparently in 2008, and we're beating that in terms of sentiment. Look, you have 12 districts, 9 of them are now either flat or declining.
Yep.
Is that not a massive recessionary signal? 3 are slightly growing, but they're really, if you look at Bloomberg Economics analysis, they're saying that a lot of that is coming down to a weaker consumer. And again, 9 out of 12 of the districts, and now Bloomberg Economics calling for 50 in September.
Right, and it's interesting that you go there to the Beige Book and not the JOLTS data, because that's quoted a lot in a lot of our stories, and yet I'm told by Simon White and the Markets Live blog to take that with a huge pinch of salt, because you don't get enough responses, and therefore we still have to keep waiting.
It's also so the thing about the JOLTS as well is it's data from ages ago. Like, it's real rear-view mirror stuff. So I take Simon's point that actually the series is a problem, but actually the timing's a problem as well in terms of what it told us. And if it's telling us that things were bad a while ago, makes you wonder what they're like now.
Yes, and of course we're building towards the non-farm payrolls on Friday, and then once we're through that, perhaps we'll be saying, wait for CPI next week. That comes Wednesday.
That's usually the trend, isn't it?
That's usually the trend. That's usually what we're doing, always waiting for something. Japanese markets will be closely watching that jobs report on Friday, because we know that the confluence of expectations of hikes in Japan and weak data out of the US can really whipsaw the Japanese currency. And we've had data out of Japan overnight, which is worth mentioning. Japanese real wages unexpectedly increasing, and this is for the second consecutive month after a long period of not seeing increases here. And it's interesting, the Markets Live blog really alerting us to the fact that markets are not really pricing much in from the BOJ.
No.
So even when we're talking about them pricing in a possible hike this year, it's around 15 basis points, and it might not, for many, come until January of next year, which doesn't sound as if maybe the market is really listening to what we're hearing from the BOJ. Just to Carter overnight, reiterating the need to increase rates if data is as expected.
And it's really interesting that this last time round is what caught the market completely on the hop.
Yeah.
And as a result of which we had this huge story at the beginning of August that the carry trade was unwinding, and that sent shockwaves through the global system. Now, a lot of that has unwound, and as a result, maybe the positioning story isn't therefore as aggressive. But nevertheless, this is something that we need to pay attention to if it's going to be an ongoing story. You also worry about the repatriation angle here as well, and what that could ultimately mean to the Treasury market if you see big Japanese institutions starting to bring money back. Let's talk about the oil story, which was yesterday. But oil is down really aggressively this week, and it's been a big move. Seems to have stabilised a little bit on this big draw in terms of the US data that we've seen. So that data is telling us that maybe actually things can stabilise from here. The story yesterday was that OPEC may try and stabilise the situation as well by not delivering the output hikes that have been anticipated. But And it's a really interesting line as well on the MLive blog this morning, talking about the idea that you look at what is happening, the signals that are coming from iron ore, then that's not good news for the oil price.
I think it's fascinating. You've been talking about positioning a lot this week in terms of the bond market and the equity market. Oil plays a crucial role in that because it used to be a hedge for so many reasons. And I think it's interesting that people may be trading oil, yes, around the fundamentals that you point out with OPEC, et cetera, but then they're also maybe not touching it for that kind of positioning reason. You've seen open interest just fall off a cliff. Jeff Curry making the point that that is also part of the carry trade unwind.
I think it's interesting that we got that news that you're talking about yesterday, Guy, in session. And yes, we're up 0.4% this morning, but we didn't see much of a rebound on that kind of news, which just underscores the softness, doesn't it, in the oil price. The fears around China, the fears around the US are so great that it doesn't matter if we're hearing that OPEC is considering not pumping as much as it was previously going to. That's not providing a huge amount of support for the price, although I accept that it is a little stronger.
The four-day chart, we're still down by 7.3% over 4 days.
Yeah, and copper's had a really bad 5 days as well. It was a little flatter yesterday, but a tough period for some of these commodities.
In conjunction with a weaker dollar, by the way, which I thought was interesting.
Yeah.
Yeah, so a lot to factor in there. Let's just go to Germany briefly, shall we? Because we've just had some data coming out there in terms of factory orders. The month-on-month data, you know, this is really volatile. We mention this often because it is just a monthly data series and very volatile. 2.9% month-on-month is the growth rate. That is a little lower than the prior number. But it is but it's higher than the negative survey. And again, the year-on-year number also higher than the negative survey.
Take WECO, go to the WECO chart, click into the charts. You'll see how choppy it is.
Yeah, extremely choppy. Just flagging it for those interested in the German story. We've had so much politics out of Germany, and so much of it comes down to the economy.
And so much negativity out of Germany about what is happening, particularly on the manufacturing side. Let's talk about what we've got coming up on the show. Some great guests lined up to talk you through what we're seeing in these markets and the wider story. Henry Allen, macro strategist at Deutsche Research, is going to be joining us at 7:30 UK time. We're going to be joined in the studio by John Neal. John is the CEO of the insurance and reinsurance marketplace Lloyds of London. Its numbers have been dropping onto the tape over the last couple of minutes. We'll update you on those. For the opening trades, we're going to be joined by Zoe Gillespie, Divisional Director of Investment Management at RBC Brewin Dolphin. 8:30, Ian Harnett's going to join us, co-founder and chief investment strategist at Absolute Strategy Research. He's positive in the short term, but is warning of what volatility might do to these markets over the more medium term, Kriti.
Yeah, it's going to be a fascinating one, and one that affects the bond markets crucially. So we've got plenty of data and auctions coming up today as well in the next 24 hours. At about 10 a.m. UK time, the UK is going to be selling some of their 2029 bonds as well. We've got plenty of U.S. data as in addition, by the way, to the Fed Beige Book that we just got, to the JOLTS numbers. The job deluge continues. We have initial jobless claims today, ADP employment in the private sector, plus, of course, the ISM Services Index. We know the manufacturing index earlier this week came out pretty weak. We'll see if that shows up in the services numbers as well. Then a little bit of central bank speak as well. Comments coming out of the BOE and the ECB. To me, I've got to say, I'm kind of looking ahead to two things over in the States. We've got Broadcom earnings later today. You're talking about chips, AI, see what that business appetite actually looks like. And then former President Donald Trump speaking at the New York Economic Club at 5 p.m. UK time. This comes right off the heels of some comments coming from Kamala Harris. I'm curious what he says and whether or not he appeals to economists and the business community.
And we'll get to a brief conversation around the US politics shortly. But picking up on your Broadcom point, yes, we're going to get those numbers. And that'll be interesting because Citi flagging, we might see an increase in sales guidance from this business around its AI customers and the addition of another large customer. They've got 3. Will they add a 4th? Will that be OpenAI as Citi expects? But this coming at a time where we've had a lot of concern this week around AI. You wonder if the market is ready to hear those words of comfort or is going to dismiss them and say, well, you know, we knew that already. You flagged UBS yesterday turning negative on ASML for the first time in a couple of years.
Yeah. The tone seems to be changing. Take a look at, we'll bring this chart up throughout the programme. We take a look at what is happening with NVIDIA versus the S&P. And what it's signalling is that NVIDIA's come down really sharply. The S&P hasn't followed. You do wonder whether the S&P is going to follow. I want to come back to the politics story, though. Trump tax cuts are going to be a huge part of that narrative. And I think it's going to be fascinating to hear exactly what Trump has to say on those tax cuts. They are absolutely enormous.
Let's get to that in just a moment. And before we do that, let's tell you some of the other stories that we're watching this morning. After a 3-month vacancy, Spain has appointed Government Minister José Luis Escrivá to lead its central bank. The move comes just in time for the leader to partake in the ECB's rate decision next week. Nvidia shares fell for a third session in New York, now down around 14% since last week's earnings outlook disappointed investors. Meanwhile, the company says it is in contact with the US Justice Department, but has not been subpoenaed over an antitrust investigation. Bloomberg has learned that US President Biden is preparing to block Nippon Steel's $14 billion takeover of US Steel. The proposed deal has been under review by regulators for months. US Steel vowed to, quote, pursue all possible options under the law to ensure the sale is completed. That's just some of the politics we've been dealing with stateside then, Kriti, over the last 24 hours to do with the steel sector. Some of it, though, to do with, and coming back to Guy's point, we're going to hear from Trump later on today, but some of what we've heard already has been around tax and Kamala Harris's expectations for what she would do on capital gains.
Yeah, there is a real policy teasing out from Kamala Harris here, and I think this is interesting because you talked about the Nippon Steel deal. She's also backed this idea that we don't want foreign control over this crucial piece of U.S. steel as well. So that's something that she echoes Joe Biden on. Where she differs, to your point, Anna, is the capital gains story. And I just want to put some numbers out here because this was really fascinating to me. Remember, one of her criticisms right now is that she is not a business-friendly candidate because she's talking about things like dealing with price gouging, making groceries more affordable, making housing more affordable, the risk of that hitting potential stagnation in the economy. But she's talking about for the capital gains tax, a 28% figure on that is currently on just shy about 21%. That is almost half what Biden was proposing.
It's a huge range, isn't it?
It's massive. He was talking about as high as 45%. Of course, this is all dependent on what Congress looks like. These are some pretty big numbers.
And this is a top rate, isn't it, in terms of that capital gains? It's interesting because globally this is becoming something of a competitive story, isn't it? You know, we've got a big debate in the UK as well about how high various taxes are going to go, and there's been ruling out of all kinds of tax increases, which leaves only a few to focus on, and capital gains is one of those.
Absolutely.
And so, you know, at the moment, the highest you can charge is 28% in the UK, but it's more typical to be in the 10 to 24% range. It's difficult to compare these figures because they don't all operate in different geographies the same way, but it is interesting that it's becoming something that perhaps countries are going to be competing on.
Yeah. And if you push it too far, do people leave? And that is the question that is being asked here in the UK as to whether or not people are going to depart the country. The UK is losing millionaires at a rapid rate at the moment, it seems. And this CGT story is definitely part of that. The Nom-Dom story, part of that as well. The Nippon Steel, that's just amazing. That's just bad timing, isn't it? Like if you're gonna push through a deal of that kind of scale, running it into a US election is a terrible thing to do.
And we should point out that US Steel has already spoken about it, so that if this deal doesn't go through, they're closing down some of their manufacturing. Nippon Steel says even if the president blocks it, as the Washington Post reports, this deal is still very much on the table. So it's interesting, a lot of tension there. Around Kamala Harris, from a policy perspective, she's kind of shifting a little bit to the right from a business perspective. And that's something we're seeing arguably in France as well, in terms of some of the candidates Macron is considering.
Are we not? I don't
know. Today, what day is it? I'll check the calendar. It's Thursday. So today we're leaning a bit further right, are we, in terms of the names? Yeah, yesterday less so. Yeah, we seem to be day after day after day just waiting and waiting for news on a French Prime Minister.
Some of the candidates I thought were interesting, though, that are now circulating in some of the papers. Michael Barnier, for example, who had run, I believe, for president back in 2022. You have David, I want to say his name right, Listard? I'm saying this is a very thick American accent, but
we'll go with it.
He's the mayor of, you put up with it this long, you might as well. He's the mayor of Cannes as well. And I thought this was interesting that these are the ones that are being considered, and they're, again, more on the right than the left.
Are these guys capable of surviving a vote of no confidence? I don't know. Who knows?
Is anybody in such a fragmented political landscape that we saw?
But the real story here is actually what Kriti was pointing out. We were talking about this yesterday off air. The call is that Macron doesn't survive.
The impeachment call.
Well, no, some of his closest allies are talking about the fact that he doesn't survive either that much longer. Now, we talk about turbulence in France. This could be the kind of the pre-warning. If Macron goes and we're into presidential elections and all kinds of changes start to take place at that elevated level,
that would be a bigger story.
That's a much bigger story.
OK, coming up on the programme, we'll take a closer look at the British fashion house Burberry, which is being kicked out of the FTSE 100, ending 15 years of presence in the blue chip benchmark. But up next, we'll be joined by Henry Allen, macro strategist at Deutsche Bank Research. Plenty of themes to discuss then when it comes to the rate story out of the US to Japan and elsewhere. If you have any questions for our guests, please get in touch. We like to hear from you. IB plus BBTV Go is the function on the Bloomberg terminal that will put you in touch with the team that puts together the programme. This is Bloomberg.
the fact that core inflation is running below 2%, to me, that suggests that they're already too tight. So going 50 on the first go is not a particularly big risk.
Neil Dudder of Renaissance Macro Research there, talking about what the Fed should maybe think about doing as inflation comes down. In theory, that makes the Fed much more restrictive at current levels. Therefore, does it need to catch up and compensate? The data certainly are deteriorating at a fairly rapid clip at the moment. The real question now for markets is, does that ultimately translate into a more accelerated pace of rate cuts from the Fed and other central banks? And how should you read that? I've been asking the question for weeks now. Is it 25, that's a soft landing? If it's 50, does that signal a hard landing, something that markets should maybe take fright from? Henry Allen, Deutsche Bank macro research macro strategist, joining us around the table. Let's talk about this. The rate of change on the data seems to be accelerating to the downside. How worried should I be? And should the central banks be reacting more aggressively?
I think we should be cautious for sure, but at the end of the day, the data we've seen is simply not yet consistent with what we would expect normally in a recession.
Right.
In a recession, in the first month of most recessions, payrolls is actually negative. And we're still not just negative, we're plus 114,000, and that was affected by weather-related disruption.
Yep.
A lot of people looking at the ISM manufacturing this week, but manufacturing makes up a smaller and smaller share of the economy. Only 8% of US jobs are now manufacturing. It's not like a generation ago when it was 25-30% and manufacturing was a great signal. Even the jolts yesterday, that's again backward looking for July. Actually, it's tomorrow's payrolls report that's going to be a much bigger test of whether we get 50 or 25.
So if tomorrow's data's OK, say we get a bounce back from the prior number, what does that tell us about where we are in terms of the US economy? Slowing down, but not that fast? Does it tell us that the labour market, that the Fed, all this commentary we've had from the Fed about the labour market is maybe overdone? What is it going to? What would a stronger number tell us about where we are in terms of the economic slowdown?
So I think it would certainly tell us that actually we're just settling into a new normal, particularly post-COVID, because I think people are looking back to 2022, 2023, when the jobs numbers were coming in regularly at 300, 400, 500,000.
Yeah.
And that was always, to some extent, going to be a catch-up from all those losses after COVID. So we were always going to settle into a new steady state, around 150,000, a bit like we had in 2019. That in itself is not a cause for alarm. So, if it comes in above 100,000...
But that was the data that panicked the market last time round.
I acknowledge that, but I think what also panicked the market was a few other things, including the Bank of Japan's hike.
Yep.
You also had the rise in the unemployment rate that triggered the SARM rules. So there are a few things going on at once, and a weak ISM the previous day, indeed. It wasn't just the jobs report in isolation. That was coming on top of quite a few other things. And actually, if you look at the rest of the data we've had for July, had very strong retail sales. Jobless claims are coming down again from their peak. And actually, even the Atlanta Fed's GDP Now tracker for Q3 is still pointing to growth at 2.1%. Doesn't look like a recession at all.
Are you nervous, though, that history could repeat a little, to Guy's point, around the positioning of... We've had wage data out of Japan overnight, which looks unexpectedly strong. We've had voices out of the BOJ talking about how the markets look calmer. And we know what that means, because they told us that they wouldn't hike again if the markets didn't look calm. So now they're giving a lot of signals that they could hike again. If we do get weak data out of the US, and if we can continue to hear hawkish signals from the BOJ, are you concerned that we have any kind of repeat of what happened in early August? Or was that also a function of just low liquidity and people on the beach?
I think that's definitely a live risk. Certainly, if I think payrolls comes in beneath 100,000, that's my threshold, because if it becomes beneath 100,000, that would be the worst of this cycle so far. So I think that would definitely add to the deterioration signs. But, if our view comes right, that it's 150,000, and that's actually a bit below the consensus, which last time I checked was 165,000, then I don't think there is a risk of a repeat. I think people will actually settle down and realise that these aren't recessionary numbers. And I think that was reflected last month in the fact that, yes, you had a pretty big sell-off, nearly a correction for the S&P, down 8.5% peak to trough, but that bounced back remarkably quickly again. And I think fundamentally that reflects the fact that the market, on the whole, still doesn't believe in that hard landing story yet.
There did seem to be, this time a month ago, there did seem to be a bit of a sense of panic as the carry trade, to some degree at least, unwound. Do you, what does that tell us about whether, well, maybe I shouldn't link the two, but we're thinking about whether the Fed is going to go 25 or 50 basis points, and some people say 50 might look like panic. Do you think that would be the signal that 50 would give?
I think that's definitely the concern, because one thing I've conscious in previous cycles is the Fed actually began with 50 in 2001 and 2007. And in both instances...
Yeah, they're not good examples, are they?
That then led to a recession.
So I mean, maybe it is normal,
that's the concern.
But that shouldn't necessarily be a normal cycle.
No, and actually, I'm conscious, I remember about 18 months ago when SVB was happening and you had all that regional bank turmoil. And before SVB, Fed were widely expected to hike. And then in the midst of the turmoil, there was a lot of speculation, oh, maybe they won't hike, maybe they won't go ahead with that. But there was a lot of narrative I saw among colleagues, clients in the market, that if they didn't proceed with that hike, that is going to signal panic. Does the Fed know something that we don't know? And I think if it's a balanced decision, if we don't see a deterioration in payrolls tomorrow, then I think the worry would be that if the Fed does go 50, that signals, hang on, we've got a bigger problem, because the other central banks aren't cutting 50, the moves are 25 so far.
What did you make of the Beige Book yesterday?
I saw one commentator, I think it was Connor Sen of Bloomberg, actually refer to it as a C+, which I think kind of sums up...
Back to school.
Yeah, where we are in both the year and in terms of what it looked like. I mean, you know, it wasn't great, clearly. I think, you know, actually some of the qualitative data that the Fed has often been a better insight to what's coming down the track, so that's certainly something I'd be keeping an eye on. But I think if you look in previous recessions, the best metric of whether we're in a recession and the slowdown is payrolls, because 10 of the last 13 recessions, the first month of recession, payrolls was negative, and we're not even in double digits yet, let alone negative.
So, OK, I take your point on taking kind of history's course here, but we're in a post-pandemic era where anything below 200 is considered the equivalent of how the markets would have received it as a negative indication pre-pandemic. And I'm curious why the markets aren't more reactive to that kind of weight, whether it's in the Beige Book or whether it's in a number that comes below 200. I recognize that we had that panic in August. A lot of it was spurred by that payrolls number. But what is the bar here? And does history, is this the time where we can say this is going to be the exception to the rule?
I think certainly that's been a theme throughout this cycle. I mean, one thing I'm conscious of is that a year or so ago, particularly after SVB, it was the consensus, indeed, that there would be a US recession. And month after month after month, that just didn't happen. And I think a lot of people have had to ultimately reevaluate where this cycle is going, because the data so far has simply not been consistent with recessionary-like levels. So, certainly I'm very, very cognizant of the fact that a lot of things in this cycle are behaving very differently. But one thing that hasn't behaved differently is the fact that, we've still had positive payrolls, positive growth, and I think you would actively need to see a contraction before we could kind of sound the real alarm on where things are going. How
are you doing the math around the immigration numbers, specifically because we got that kind of revision to the labor numbers of 818,000, I want to say a couple weeks ago, and so much of that was attributed to miscounting on immigration and laborers or contract workers. How are you doing the math around that?
So I'm actually not too concerned by the revisions, to be honest, because one thing that, firstly, the revisions only actually go up to where we were at the end of March, April time. So even with those downward revisions, and assuming they're not revised again in future years, because we know that that can happen even many, many years later, that doesn't affect our kind of recent picture of where the economy's been in the last 5 months. So personally, I'm fairly sanguine on that. And actually, if those revisions are correct, as it stands, actually what we can see over the last year, 18 months, is actually a much kind of flatter path of payrolls, whereas what we thought we had before those revisions was actually a deceleration. So actually there might even be some more positive signs from that this deceleration is actually over-egged.
Yeah, I'm curious to see how that all factors into the further calls for those rate cuts. Henry Allen will leave the conversation there. Deutsche Bank research macro strategist. Thank you so much for joining us around the table this morning. It's a fascinating one, guys, when we talk about kind of the read-through from the labor market into whether or not we are actually going to see 50. The calls for that in the last 24 hours growing.
They do seem to be. We seem to go through bouts of this, though, don't we?
Yeah.
We go through bouts of it and we worry about it. We saw it at the beginning of August. People were talking about emergency rate cuts then. Now we're back to talking about 50. You get a solid payroll number tomorrow, we're back to 25.
We'll be saying wait for CPI on Wednesday. That's what we'll be doing.
Absolutely. But it's a big story for Lloyds as well in terms of what they're going to be watching. The insurance market out with numbers this morning. We are going to be talking to the CEO of the insurance market. He is going to be joining us next. John Neal, looking forward to this conversation. What happens in the bond market affects this business as well. This conversation's next. This is Bloomberg.
Welcome back to the programme. 30 minutes from the start of the European opening trade, and this is the futures outlook for you. This is what futures look like. They look a little negative, which is interesting because yesterday we saw European equity markets closing down quite substantially, down by 1.3% on Euro Stoxx 50, whereas US equity markets managed to not eke out gains, but, you know, the losses were not substantial. And it felt as if we were, you know, so maybe there's some further movement here in Europe to catch up with everything we saw stateside. So we will see where that takes us. But for the moment, expectations are that we get a little bit of negativity coming through on the stocks picture, Guy.
The insurance market, Lloyds of London, is out with its numbers. Let's give you a quick heads up on what we're seeing here. £4.9 billion in profits, £30.6 billion in gross written premiums. The combined ratio, 83.7. You kind of want that number to be significantly below 100. That tells you good things. So the numbers broadly look fairly favourable. But the CEO, I read the comments this morning, talking about the fact that this is an increasingly risky world. So what do these numbers look like going forward? Let's find out. The CEO of Lloyds of London is sitting next to us. He, of course, is John Neal. Welcome to the programme. Good morning.
Pleased to be here. Thanks for having me.
Do these numbers reflect an increasingly risky world?
I think from our point of view, you know, we're doing two things. You spoke about it. One, we're performing in terms of a value proposition for investors. We're making a profit. Really importantly, we're also growing. There's 6.5% of growth in there. So I think for the first time in my career in insurance, which scarily is almost 40 years, we're seeing insurance grow at twice the rate of GDP. So whether that's the financial challenges of interest rates and inflation, whether that's the systemic exposures we saw through COVID, whether it's war on land, dare I say it, whether it's climate, I think businesses, individuals, governments are thinking it's a riskier world. Can insurers help? And the answer is we can.
Is there more insurance, or is insurance becoming more expensive?
Bit of both is the honest answer. So we saw quite a bit of price change, particularly in areas that were extremely vulnerable. So there is much more insurance bought in the US than there is in Europe, almost twice as much, because of the perception of the reality of weather-related events. And you saw quite a significant price change. But genuinely, if we talk about organic growth, we've actually seen organic growth of 5%. So people buying more insurance is growing.
So that's interesting, that insurance is growing 2 times GDP, and you say that reflects the risky world, and that's a world that insurers can help with. But can they help everybody? I'm reading a really interesting piece by our colleagues yesterday about captive insurance, and this quotes one of the insurance brokers, Aon, as talking about companies creating their own coverage vehicles in particular sectors where they can't get insurance coverage. I mean, what does this represent? Some of them use special purpose vehicles. What does this represent to you? Is it just temporary, a transition?
No,
what is it?
It's a growing market. You're right to highlight it. I mean, I think by the end of this year, the captive insurance market will be worth about $300 billion. So you have always had businesses debating what they might want to retain on their balance sheet. And bear in mind, you can actually locate your captive at Lloyds, I hasten to add. So we have got an environment to support captives. So businesses will always make some decisions on what risk they're prepared to retain. But there are risks where they'll turn around and say it's too volatile, therefore we're better translating that away from our balance sheet. So we're fine with the captive structures. What we've got to get in and do is explain our value proposition better so that businesses are retaining the right risk and not retaining too much risk. OK,
so just because there's captive insurance in the market doesn't mean that you're not seeing some piece of that. That is something that Lloyds can help with. But what does it tell us about... I mean, some people are saying this is going to delay energy transition because maybe the messaging from the insurance world not being able to provide this insurance was that it's too risky. And then if businesses are making their own plans so that they can carry on with this activity, it delays transition. What message do you take?
No, so it's interesting. So if we drop it into the energy space, because it's quite a good place to go. So, you know, in the world we're in today, 80% of the world's energy comes from fossil fuels, whether that's coal, gas or oil. We've been very clear and said we want to ensure transition. That includes the harder-to-abate industries, because we've got to move from where we are to where we want to go. Roughly a third of the insurance finds its way into captives. 2/3 still finds its way into the insurance industry. So we have got a role to play. Yes, captives will play a role, but we have a role to play in that space.
John, the last time we had you on this program, we were talking about the tragic collapse of the Baltimore Bridge. And that shows up in your numbers here with about a £500 million pound hit. your numbers have also come out very strong, which means that there's a bit of cushion there despite absorbing that hit. And I'm curious how much of those numbers show a little bit of luck on your side in terms of the hurricane season, in terms of kind of the natural disaster protection to help you absorb the costs from the Baltimore Bridge.
Sure. I mean, we always set aside a percentage of the premium every year against major losses, whether that's a North Atlantic hurricane season or whether it's something like the Baltimore Bridge. So we expect those losses to occur every year. You know, if you think of all the press has said the North Atlantic hurricane season this year is going to be the worst on record. We're halfway through quiet so far. That doesn't mean it will be quiet, but we're well used to complex loss. And if you like, being able to absorb that loss, it's our day job. When you think of weather-related losses, the cost of those losses has doubled in the last 20 years, from 60 billion to 120 billion. Yeah. We think it'll double in the next 10. We know that, we understand it, and we are happy to take the risk.
Let's talk a little bit about perhaps a little bit more of the domestic risk to your bottom line in the form of taxation, if we can. There's a big concern that in the next couple of months we're going to hear about an increase in that. You've been very outspoken in the media that this is not a positive thing for UK businesses like yourself. How do you combat that? What are the conversations you're having?
So I think from our point of view, I mean, you know, I was also on record as saying that change would be a good thing from a government point of view. We all needed certainty and stability, so a two-term government would be a good thing, not a bad thing. I think from UK PLC, where financial services, I think, is genuinely important, we just need some stability around tax, whether that's personal or corporate, and we need a competitive lens on our regulatory framework. So, yes, we've got to regulate well, but we've got to ensure that we're an attractive proposition for businesses for a number of different reasons. So we'll be vocal in saying that's not our job to set policy, but we will be vocal in making those points.
How does that affect, though, not just you, but the reinsurers you work with as well? If we're talking about this very strong kind of commercial underwriting trend, doesn't that kind of take a big chunk out of that?
We've got to be very careful. So 80% of our business is non-UK derived, so most of it is international.
But you're having the same risk in the US, no?
Correct. So if you look at the world at large, 70 of the countries in which we trade will have been through elections in the 12-month period that we're talking about, 60% of the world's population. Ironically, I know this sounds odd in the context of the question, we probably feel more stable here than we do in many other places. When you look into Europe, you look at the uncertainty in France, in Germany, what does that really mean for Europe? In the US as well, we've got the elections coming up, what does that mean? So oddly, we probably feel more comfortable in understanding the direction for the UK at the moment than almost anywhere else.
Let me take a sort of derivative of what we're talking about here with the election story and focus on the UK, but actually focus more broadly elsewhere. Governments want to build more houses. If you want to build more houses, generally, increasingly, you're building them in riskier and riskier areas, which makes them hard to insure, which is one of the factors that maybe is holding back some of the house building that we're talking about. Should insurers take all of the risk when it comes to building new houses, or at least insuring those new houses? Do we need to find a new way in which the mortgage industry, other industries, start to absorb some of the risk around where some of these houses are being built? And how big an impediment do you think actually the mortgage risk associated with house building currently how big it currently is?
So you're on my side, aren't you? I think the answer is yes.
Not necessarily.
Yes. I think we need the banks, the insurers and government in the same room. So if you think of different parts of the world, I lived in Australia for 7 years. You imagine Queensland, the weather-related events there are truly mind-boggling. So can the insurer take all of that? They can't. You know, if the banks own the asset ultimately and they're making the loan...
Through the mortgage, yep.
Correct. They need to accept some of the risk. The insurer can take some of the risk, and maybe government might need to be the insurer of last resort. So I think for the first time we need to think about some partnerships. How do banks, insurers and governments join up?
How big an impediment is this to house building unless it's resolved? It strikes me that a lot of the houses that are being built at the moment do represent increasing risk.
Yep.
If we are going to build even more and in much greater numbers... Can you quantify this for me?
No. Bring it back home, because I think it's a great question. When you look at, say, flood-related insurance in the UK, you know, when we look at numbers, we think as many as 6 million people are underinsured for flood in the UK. That's not a good point, and we cannot keep looking to the government as the insurer of last resort. Right. We can't do that. So I think it's really important that people are we're all brought to the table, because there is a solution. It's not as if we don't have the financial muscle power between the banks and the insurers to solve the problem in the majority of instances. So let's have that conversation. Let's have government in the room as well. So if government needs to be there as an insurer of ultimate last resort, let's have that conversation.
No doubt AI is going to be something that increasingly is part of the insurance industry and helps to solve all kinds of problems and maybe helps on some of the ones we've just been discussing. I know that you've been trying to engineer transformation, modernisation at Lloyds of London, and that's been an ongoing process since you took over as CEO, John. You know, the pandemic changed people's plans. But what are you discovering about the ability to transform a business, a really, you know, historic business like Lloyds of London, and its ability to adapt to an era of AI, for example?
So I think the short answer is, you know, whether we want to or don't want to, and I think we do want to, we have to adapt. You know, we all think of the technology revolution, what technology has done. I think it creates the space to grow. And I think actually it creates opportunity, not threat. So I think when people stand back, a bit like, you know, when I first started in the industry, we didn't have computers. You know, think of the massive opportunity that's created for business. AI will be the same. So, you know, if you look at our marketplace, over the last 6 or 7 years, we've grown by 40%. You know, I'd like to see that growth able to continue. I think AI gives us the opportunity and the capability.
Are you surprised it's as difficult as it is sometimes to transform businesses from being quite manual to being, you know, first digital and then, you know, driven by artificial intelligence?
I think provided you see it as a continuous cycle of change, I think it's fine. You know, if you've hesitated to change and you're trying to play catch-up, I think it gets hard. But I think provided you're in the cycle of saying change is constant, I think it's OK.
Thinking of technology, we gave much coverage to the faulty software update that came from the cybersecurity firm CrowdStrike. No doubt that caused up problems for some of your customers. Perhaps that's pulled out in the detail of what you've said this morning. But any sense that that's a risk that's growing? What can you tell us about the outlook there?
So I think, well, you know the story better than me, really. You know, if you look at someone like Microsoft, they're putting, through 6 or 7 major updates every day, which I think was a shock realisation for people. In our world, you know, one of the fastest growing insurance products is against cyber-related threat or risk, and we're very happy to accept that risk. And in a way, this issue will explain to people that there is a value in buying some protection in the circumstances you might find yourself at CrowdStrike. Actually, it wasn't a particularly large insurance loss. You know, from our point of view, we were talking about Baltimore costing us $500 million. This is in the tens rather than any more. But it's an illustration of the reality of the threat and the risk.
Great to see you, John. Thanks for talking about us.
Thank you.
Really appreciate it. John Neal, Lloyds of London CEO, the world PC, pre-computers. OK, coming up, we're going to talk about what's happening in France. The country, the world, focusing in on when we are going to get a new Prime Minister. We've gone left, now we're going right. Where are we ultimately going to land on who are we going to ultimately land? That is the key question. We'll focus on that next. This is Bloomberg.
We are 14 minutes away from the opening trade here in Europe. Good morning, everybody. Let's have a quick look at the futures. The futures picture for Europe looks negative. US futures, meanwhile, also negative, but not by quite so much, down around 0.25% on Nasdaq futures. One thing is for sure, we have seen more volatility in stocks of late. Going back to August, we certainly remember that, but it's picking up again. Kriti, you have a chart on this very subject.
I do, and I think we're all trying to figure out how long the doom and gloom continues. The red on the screen that we're seeing, how long does it last, given we kind of just came off of a correction less than 30 days ago when it comes to the S&P 500. The question is what sparked it, the fundamentals or perhaps the Guy Johnson positioning story, which is where I'm going to go next. This is all about the options market. This is my current obsession, where you can actually put this into some context. Take a look at this. You are starting to see the increase in the last couple of years of retail volume and how that shows up in the option story. But the most latest moves have really been functions of the VIX. And this is where Nomura is saying that a, quote, massive freakout was behind those market moves. And you can see that we are getting very close to, in terms of options volume, where we were just 30 days ago. The question here, though, is what actually drives it forward, especially given there's still plenty of options positioning going into the payrolls data, which is why, even though on the surface, maybe we're seeing, of course, this decline in the S&P 500, a little bit of calm in the bond market, underneath the surface, you are seeing a lot of different rate moves. And also, when we're coming this right back to the stock market, Anna, this is crucial because when you look at corrections in the market, the S&P 500 tends to have corrections of about 5% or so, anywhere from 2 to 3 times a year. That is a normal year. And then some sort of 10% correction once or twice a year. That's normal. This year, we've only had one 10% correction, and that, of course, is feeding into the September seasonality story as well, Anna.
OK, yes, important to note what is normal and what a normal year looks like. Kriti there with the chart that has caught her eye this morning. Let's talk about risk appetite in the market. Joining us now, our Markets Live executive editor, Mark Cudmore, with his thoughts. And perhaps you think we talk about September seasonality too much, Mark, but I know that thinking about where stocks go in September, with that sort of back-to-school feel is an annual activity. What are you expecting to see in terms of market positioning and market response to the payrolls data that we get on Friday? It seems as if everybody after last month is pretty nervous.
Yeah, they are definitely very nervous, and all the seasonality conversations aren't helping a lot. I think it's hard for non-farm payrolls on the headline to support stocks. I think a negative number a weak number would get people very worried that a recession is coming, the Fed is behind the curve, and therefore stocks weaken. I think if we get a very strong number, well, because rates are now pricing in a very good chance of 50 basis points in September, I think that knee-jerk reaction in rates wouldn't be great for stocks. So I don't see the short-term reaction being particularly supportive for stocks. That said, I do think that, by next week, unless it's a very weak number, if it's either in line or strong, I think stocks will actually do fine again. I do think that the concentration on seasonality this year is particularly intense, but seasonality shouldn't be over-interpreted, and September seasonality is distorted by several particularly dramatic months over the last 25 years.
Mark, Nvidia has come down fairly sharply. The equity market, the S&P, is not following it yet. Will it?
Yes, in direction. In terms of drama, no. I think that we're going to continue to have volatility. I think Nvidia is so important that it's going to kind of weigh on the broader market out there. It's not just that it's waiting; it's that it's representative of the golden darling theme of this year. But I do think that that the rest of the market is unlikely to panic. I just don't see the negative fundamentals there to cause this market to particularly panic. So I think the rest of the market will do fine. Can the rest of the market rally when Nvidia is selling off? Probably pretty hard, but it'll probably do okay.
Mark, I want to ask you about the other part of that August freakout, if we can say, on August 5th, and that kind of carry trade that played a role in it, specifically because as we speak, we are seeing weakness in the Mexican peso and weakness in the dollar, both against the Japanese yen, going back to those levels of August 5th. And I'm curious about your thoughts, now that we're about 30 days out from it, on the carry trade and how much further we have to go on the unwind.
I think the Mexican peso story is really idiosyncratic here. In August it was very much a carry trade unwind. I think right now this is about the judicial reform in Mexico, and I think what's happening there is very much specialized to Mexico and not about a broader carry trade unwind. I do think there's still some lingering carry trade, and I think if you see some dramatic yen moves, we could still have some more pain there, but I'm not sure it's the main dynamic at the moment. At the moment, this is concern about global growth, both around China and a little bit about the US, and that's what's weighing on stocks with a side dose of Nvidia.
All right, Bloomberg Markets Live executive editor Mark Cudmore, we thank you so much. You can get more up-to-date analysis from him and the team. Just type in MLIV GO on your Bloomberg terminal. Let's go from the macro to the micro and get your stocks to watch. Lizzie.
Well, Kriti, first of all, I want to start with the French stocks because equities in France were on tenterhooks yesterday, really waiting for a decision on who is going to be the next French Prime Minister. It didn't come, the Elysée having to disappoint by the end of the day. But as we await that announcement, we keep an eye on Crédit Agricole, BNP Paribas, SocGen, all the other French stocks. But really, the CAC 40 has underperformed the Stock 600 year to date. So we could see a change in their fortunes, perhaps. Then I just want to cycle through many of the earnings that we've got out today, but focusing on Vistry. Interesting because yesterday, remember, we were talking about Barratt Developments, another home builder. And Vistry is kind of different to its peers. First of all, it said that completions increased in the first half from a year earlier. For Barratt yesterday, that fell. Vistry also has a bit of a different model. They focus on partnerships, and investors have been really rewarded for it so so far this year. You can see shares up 43.5% year to date. Remember, overall, home builders kind of rubbing their hands at this new Labour government. They've got plans to boost home building, particularly affordable housing, and that's what Vistry focuses on. So this new planning overhaul, good news for them potentially. They've also announced in these earnings a further £130 million share buyback because of higher revenues, because of the pre-tax profit in the first half. Next up, I'll just cycle through the other earnings that we've got this morning. We've got AB Foods, of course, the owner of Primark. They've maintained their guidance, but says that Primark sales will decline in the fourth quarter because of the weather hitting the football. Then we've got ASOS, the e-commerce brand. Earnings out at the top end of estimates. They're selling a load of Topman and Topshop, about a 75% stake, to Heartland to form a joint venture. They make reference to AI, which takes us on to Currys. Currys has been getting a boost from AI demand, but also people buying tellies to watch the Euros.
All right, Lizzie Burden, we thank you so much. Bring us some of those stocks to watch. There's a couple others we've got our eye on. Anna, you mentioned this, headlines coming out of Volkswagen.
Yeah, absolutely. So we're getting lines coming through from IG Metall, one of the big unions over at Volkswagen. The negotiator there saying they're expecting VW to make a pay offer to its employees. They're keeping their demand for a 7% raise, 170. You know, the detail is there. This in the context that we've heard from Volkswagen, they are considering shutting factories for the first time.
This is part of the problem that all of these European car makers have with the electric transition. It's not going fast enough. It's not going in the way that they anticipated. You're seeing the same thing with Volvo Cars as well. It's warning that it won't be able to make its targets in terms of going fully electric. That is something that has caught a lot of people by surprise. The stock's called sharply down also on its outlook in terms of its statements this morning. European car makers are really struggling
And some of that's
now.
a regulation story, though, because part of what's hurting Volvo Cars is the issues with bringing Chinese manufactured cars into Europe.
Yeah, we're certainly going to see that, and how the policy impacts some of this decision-making. It kind of feels like the folks over at Volkswagen and Volvo Cars are looking at what's happening in the politics, maybe making those decisions accordingly. We're going to see how it all shakes out at the opening trade. That coming up in just a couple of minutes. Futures are indicated lower red on your screen. Stick with us. This is Bloomberg.
Thursday session beckons a couple of minutes to go until the start of equity trading here in Europe. What does the legacy look like out of the United States? Remember, yesterday we gapped lower here in Europe. We're still down over this week by circa 2%. Yesterday, in terms of where Europe was, a fairly flat session. The US actually declined a little bit after we saw the European close coming through. We are basically counting you down to the start of the real data series that we're focused on. We're going to get ADP today. We're going to get claims today. These are more current series. Then, of course, we get into the payroll numbers on Friday. That is going to set the tone. Does that mean we get a quiet session today? Certainly volatility has been a bit of a theme this week, Kriti, but what are the futures telling us?
Well, the doom and gloom does continue, or it seems to bleed through, but perhaps not to the same extent that we've seen in the last couple of days. Guy, I really want to focus in on the European story, though, as well, because down 0.4%, it's not just in terms of positioning or the tech read-through that we've been talking about. We've also got our eye on Chinese growth stories and the read-through from there, not to mention the political turmoil we're seeing in France. How does that show up in the biggest French companies? That's going to be weighing on the Euro Stoxx 50, FTSE 100, down 0.3%, Anna.
Absolutely. So we'll keep an eye on those French stocks as a result. Another list of stocks for you to keep an eye on. We'll certainly have car makers of various types in focus. VW, we just heard those lines from the unions as that business goes through some really difficult decision-making, and the unions asking for more pay at a time where management are trying to think about closing factories. ABF is in focus. It seems they're stumbling on their sugar business, weather hurting Primark perhaps, but there has been some more positive signs elsewhere, so we'll see what holds sway there. ASOS is interesting. The clothing retailer, sales slightly below guidance. Some capital moves there as well from the management. Guy, what do we see at the overall level?
OK, here we go. It's time for the opening trade. Let's see what numbers we get posted first thing this Thursday morning. It is the 5th. Let's see what we are looking at. We are anticipating a negative start to the day. We are basically counting you down to US payrolls. That appears to be what everybody is now waiting to see whether or not it confirms whether we're going to get 25 or whether we're going to get 50 out from the Fed. So we start in the red, the FTSE 100. We don't have the FTSE 100 today. We're back to the FTSE mid, but we'll show you what the FTSE 100 looks like in just a moment. The Stock 600 is down by 0.1%. The IBEX is down by 0.5%. CAC 40 is down by 0.5%. So broadly, you're getting the picture. We are down circa 0.5%, Kriti, in terms of the index. What's going on below the surface?
Well, let's start with the FTSE 100, shall we? We are seeing red on the screen here, and a lot of this is coming from your typical outperformers. Again, it seems to be a fairly broad decline to the downside when you look at some of the bank stocks that are down. But, Anna, you've been mentioning this a lot. Commodities taking a bit of a hit when it comes to the FTSE from a sector point of view. The Stock 600, we're still waiting to shake out because, remember, we are waiting for some of those German companies as well to trade. Volkswagen, Volvo Cars, those some of the names that you had your eye on as well. The outperformer, however, seems to be utilities, which is interesting. I'm curious how much of that is a defensive trade.
Yes, could be defensive. In terms of the commodities markets, yes, we've seen iron ore and other metals weak again, and we've had days and days of weakness coming through, certainly in the copper price, iron ore not having a good experience, and that tying in with the weakness we've seen in oil. Oil is a little firmer this morning, but all of that, of course, does move things around in London just a little bit. We do have some movement then in some of the companies that we mentioned, a slightly smaller one, but of interest. Perhaps ASOS is up by nearly 10% this morning. A lot of complicated things being announced there, but there's refinancing in the mix, which perhaps is having an impact on where the share price is moving, even if they're talking about some of their sales guidance being a little bit light this morning.
ABF, I'm just waiting to see what is going to happen there. Actually, I don't see a price on ABF this morning. This is the Western family-owned business. We often think about it as being a kind of food business of sugar, but it's actually, this is Primark, and it does seem as if Primark sales fairly flat at this point in time, and that appears to be taken as something of a negative. There is this trade-down story that people obviously are watching fairly carefully, but the British consumer actually, in some ways, holding up reasonably well at the moment. Yeah. Which, if you look across the piece, actually is a bit of a surprise comparing it with other countries. But nevertheless, we'll wait and see what those numbers look like. But ABF was expected to be down sort of 3-4% this morning.
Yeah. Well, speaking of some of the other movers, in the UK, you are seeing to the upside. You are seeing Reckitt is one of your biggest movers to the upside, I should say, and seeing some heavy volume. To the downside, though, you're seeing France underperform. Hermes seems to be taking a hit, down about 1% here. LVMH is also under pressure as we're seeing some of this pricing shake out, also down about 1% as well. I'm curious how much of this is a little bit of a luxury bleed through, given I believe seeing some weakness in Tiffany in China as well. I'm curious how much of this is going to hit the rest of the sector.
So they've announced that their store they're going to halve the size of the store, basically, yeah. Which is a pretty strong signal that they're not anticipating big demand going forward from here, and that story is becoming more and more negative. Is it being compensated elsewhere? The US feels like it's rolling over as well. I don't know. This is an area that has been of such strength for Europe, and Burberry's going to be kicked out of the index as well, it looks like,
yes,
from the FTSE 100.
We're going to get that full story with our colleague Deirdre Hitwell coming up a little bit later on this hour. To your point about luxury, the CAC 40 then down by 0.5% this morning, and we see a lot of the luxury goods sit there. Let's talk about where we are on these markets as we head firmly into September now. We're joined now by Zoe Gillespie, Investment Management Divisional Director at RBC Brewin Dolphin. Zoe, nice to have you with us. I mean, today's picture on markets looks a little, well, risk-averse, perhaps. Maybe some rates plays in the mix there. We see real estate and utilities as the best performers, chemicals and basic resources, those, you know, very subject to the ebb and flow of global growth. Those are selling off this morning. How do you approach September? How much risk appetite do you have?
Thank you. I think we saw that, obviously, August played out. Start of August, non-farm payrolls set the market into a kind of tailspin, and we saw volatility kick through. And by the end of the month, I think we had a bit more clarity. The job numbers seemed to steady the market. And I think, given that we feel as if it's a bit of a repeat that's happening again in September. So we've got, obviously, the non-farm payrolls on Friday. But there's certainly, I think, a bit of nervousness coming in, whether the consumer starting to weaken, whether we do see a slowdown in the jobs market, and then obviously the all-important rate cuts coming through, and whether it's actually going to be the soft landing narrative or we're going to see something worse. So from our perspective, you know, we're still bullish on equities, and I think we're just going to have to let this play out and see where the shake-up takes us, really.
So if you're bullish on equities, do you think that equities can do well even as the Fed cuts? Some people like to describe it as an equity market that can rally as long as the Fed isn't cutting for sort of panicked, really bad growth reasons and unemployment isn't much higher. whereas equities might struggle if the Fed is cutting with some panic in mind.
Exactly, and I think if we see a kind of, as you say, an aggressive rate cut because of recession, then obviously it's going to put the equity market potentially at risk. But I think if you look at the earnings season we've just had, I think it's been positive. We've had more, certainly, companies with beats. I think the actual markets look fairly resilient. We don't see any weakness in earnings that would give us the real fear that recession is coming. So I think looking at the fundamentals of companies, we're still quite positive on the outlook. Volatility is a normal, natural thing, and you're always going to have, I think, this with... We've had a period of consolidation with rates, and now we're looking at the rate cycle. And I think markets are pricing in that rate cuts, and I think that's really what we're kind of coming down to, is what's going to be the first cut, and whether the Fed's going to go for the 25, go for the safe option, or whether the 50 is going to be the first cut. And I think we're still probably in the camp that we're going to see a 25 basis point cut just now coming through.
Are bonds going to do better than equities?
I think near-term bonds have done a bit better, and I think in a volatile time you've seen that. And I think that's from our perspective for building out clients' portfolios, where we have actually been certainly more supportive of bonds. But longer term, I think you've got to look at it and say, well, I think we're certainly more in favour of equities, and we still think the equity play is why we've got an overweight equities and why we're still a bit more neutral in bonds. OK,
so do you near-term, do you think the highs are in for equities? You sound like you think that actually there are gains to be had from here in the equity market. Where does the momentum for that come from?
Well, I think the momentum still comes. I mean, we still think the AI story will play out. And I think there's a lot of the weakness that we saw in any sell-offs we've had in the last couple of weeks. They've seen buyers come back in, and the likes of Nvidia. We had a bit of a sell-off in August, and certainly we got some buyers in. And we still think that narrative's going to play out. It might be that we have less upside from the next couple of months, but I think longer term we still see that as a play that we like. Looking at other sectors, healthcare had a really good reporting season, so you see kind of momentum in that sector as well. And I think certainly from our perspective, we're looking at equities and just thinking that fundamentally there's good companies out there, and we're still quite happy and keen to pick up good quality names. Whether the rotation starts to kick through after we see rate cuts in other sectors that haven't potentially been as strong, the likes of the small and mid-cap and other areas, which actually might benefit from rate cuts in other sectors which are more cyclical, and we might see this rotation actually broaden out a bit, and we think that's going to be supportive for equities.
So you mentioned two key sectors there, tech and healthcare, and they both seem to be, at least in this region, facing the exact same issues, which is valuations and whether or not, to your point, some of that success is done and will continue to play out. I'm curious, though, what names you're targeting, if you can, speaking within each sector. If we have this Nvidia narrative that, to your point, still has some room to run, where? What stocks does that show up in?
Well, I think we're seeing the semi space, not just Nvidia, but there's still we like that as a trade, so not just one. But I think that was just an example of one where there was a bit of a sell-off when we've seen that. We've obviously got AMD and other sectors, so there's a lot more depth in that sector, so it's not just one stock, and we think that could broaden out, so we've got that as a trade. And within healthcare, I think you look at some of the equipment makers, you've seen the likes of Alcon, Stryker, some of these companies have had a really strong year. And I think there's more to play there, and we saw that in reporting. They were the best sectors in terms of, healthcare was the best sector in terms of the reporting in Q2. And I think that was a lot of the strength there. And obviously you've had the weight loss type, the GLP-1s coming through, and Novo and Eli Lilly. So there's strength in some of these sectors. And I think you're right, valuations are maybe a bit stretched just now, but I think we've got to kind of look at it and sort of look at the longer-term picture. And we still think these are areas which we're keen on.
Let me just jump into the conversation with a bit of breaking news coming through on AstraZeneca. This red headline just hitting the Bloomberg terminal. China detaining AstraZeneca staff in a data drug import probe. So this is police in China detaining 5 current and former employees of the British drug maker AstraZeneca for questioning about potential illegal activities. This is interesting for a number of reasons. This is a business that has expressed a lot of confidence in China, has exposure in China, significant exposure in China. Also interests me, and we haven't got comment, we've approached AstraZeneca, of course, for comment here, but they have not decided to comment at this point. It will be interesting to see how they respond here, because back in 2022, they fell foul of Chinese authorities, and then they disciplined staff, and it seemed as if they sort of took that one on the chin. We'll see whether this has a different political tilt to it, or how the business responds on this front.
If you take a step back, it just flags again, though, the China risk. More companies have exposure to, how many companies have exposure to China that we're not fully recognising here? How much of that is priced in? Astra is deeply embedded into the Chinese market and has made a big play in making investors aware of that.
Yeah.
But is that something that increasingly is going to attract a discount? You're obviously seeing it within the tech sector. You look at what's happening with ASML. Is this going to be something maybe that we need to factor into our thinking as well from a drug sector point of view?
You make a crucial point. About 13% of AstraZeneca's revenue is exposed to China, and they're looking, to your point, to grow it. And I think this is fascinating. In the conversations we've had in previous iterations and interviews here, is that when it comes to the China risk in terms of, say, the U.S. election cycle, we know in the U.S. there has been push against the pharma sector to kind of pick one or the other. Is one we see in the tech sector as well. AstraZeneca has said, well, actually, we're still going to be moving ahead with our plans in China. So we'll see how this all shakes out. But Zoe, I want to bring you back into the conversation because that China risk, we've seen it show up in the European markets, most through luxury. Your take on the luxury sector, is it China? Is it the risk in France right now? Is it the U.S. consumer? What is the Achilles heel of that sector right now?
Yeah, I think when you looked at it, I think it was certainly a good kind of China play, and we thought when the Chinese consumer came back in, and I think certainly the start of last year, luxury was doing well. The recent results certainly showed that there was weakness in the Chinese market, and I think now you're starting potentially to see a stretch in the US consumer, and that is a huge market for them. So we have seen weakness in the sector. I think we've seen the likes of Burberry today dropping out the FTSE 100. And I think there's also a bit of a shake-up between what's actual premium luxury and what really is now luxury and what's potentially going to be traded down from luxury, and whether consumers are being more picky about what they buy. So I think the top end, the very high luxury, maybe isn't going to be impacted if the consumer's there. But I think certainly China and if the US does start to sort of feel it, then it's a sort of an area you could see weakness. And I think that's going to other sort of sectors. We've seen it with beverages too, with the likes of Diageo, with certainly some of the consumers struggling there. So I think there's potential weakness coming through now, not just China.
Should investors see being kicked out of the FTSE 100 as a bad thing? Because it's really interesting. So companies generally, you see it coming, you know you want to trade lower. There is an index kind of effect that generally gets priced in before you get removed. It's interesting, Rob Arnett's been talking about this, the FT's been picking up on it, talking about the idea that actually companies that are removed from major indexes, and you see this over in the States as well, but here in Europe, Hiscox is coming back in. It's had a really great run. Is there a sort of... Do I see this as a kind of a bottoming out process for companies like Burberry? Do I see this as an opportunity, not necessarily as a threat in terms of the share price performance?
Well, I think a few things. I mean, obviously, from a kind of perspective of, I think, a brand, certainly, if you look at some of the European names, would France, I think, if they were to see something like LVMH, I think from an iconic basis, Burberry is a British brand. So I think it's quite, coming out of the main index is an issue. Whether or not we see it as potentially a takeover target, I don't know whether somebody might come in and look at it as that. But, you know, you've obviously got a lot of the exchanges, if an ETF might be selling down, so there can sometimes be a bit of weakness just because of the fact it has come out of the FTSE 100. But it's fundamentally, as a business, whether it is still going to have the recovery and whether they're going to have to reshape their business. They've had a few CEOs, and they've tried to have a different direction, but at the moment, it's whether they go back to what they were doing at best and look at outerwear and their more iconic raincoats and things to try and recover it.
Well, the weather's certainly turning. So, nice to see Zoe Gillespie, Investment Management Divisional Director at RBC Brewin Dolphin. I think Rob Arnett's going to be on the show next week, so we can talk more about this. Anyway, let's talk about the Call 6, see what's happening right now. This is the picture we find ourselves with the major stocks across Europe. As you can see, an awful lot of red. LVMH, Ferrari, ASML, Schneider, Nestle, all lower this morning. It's interesting that Novo is the one stock story that actually stands out on the upside, talking of healthcare. Let's get some more single stocks that we need to be paying attention to. Lizzie Burden has all the details.
Risk-off day, so let's start with the losers this morning, and they include the European miners. So we've picked up BHP, Rio Tinto, Anglo-American, all in the red, because we've got iron ore prices keeping tumbling, actually to their lowest level since 2022. China's main steel industry group advising mills to be cautious about boosting output too quickly in case they snuff out this post-summer recovery. But they have been some of the worst performers on the FTSE 100 over the past month, and and that continues this morning. Just flipping over to another pretty negative story today, AB Foods. You were talking about the weather. Let me bring you another very British story here. It comes back to Primark sales declining in the fourth quarter, they expect, because of the weather hitting footfall. So one of the biggest fallers on the stock 600 this morning, the biggest drop in more than a year. But then let's come to the winners, shall we? Vistry shares, I mentioned these earlier, earnings out this morning, and they are up today, one of the biggest gainers on the stock 600. The home builder saying that completions are up, in contrast to Barratt Development's completions drop yesterday. Traders also appearing to like this £130 million share buyback announced this morning because of higher revenues and pre-tax profit in the first half, and the new government's house building plans benefiting Vistry as well because of their focus on affordable housing. And then more positive news, staying on the fashion theme, ASOS shares up 12% now this morning, earnings out at the top end of estimates. They're selling a load of Topshop and Topman, but also they make reference to AI. Returns, obviously a bit of an issue for e-commerce brands, but artificial intelligence helping them, along with personalisation and improved imagery, to keep that returns rate at bay. They're your movers this morning.
Thanks very much, Lizzie. Lizzie Burden with an update for you. Coming up on the programme, tumbling sales and profits, and now it's been relegated from the FTSE 100. We've mentioned this a couple of times this morning. We'll get that deep dive, that focus on Burberry's troubles. That's coming next. This is Bloomberg.
We've seen softening in the demand, even though the beauty market in the UK remains very dynamic at around plus 10%. So it's a very resilient market, but it's been softening lately, especially as we see people arbitrating with also the rent increase, the mortgages.
This year started with an expectation that the luxury markets will grow between 2 to 4%. My personal feeling, it will be much less than that. Probably it will be flat. The reality is that Europe, US is still very flat at the moment, and China is still weak.
If I look at China, we do see some slowdown in the luxury side of things. I mean, in the premium sector.
China is a very essential market for the luxury ecosystem because of the fast adoption of luxury, because of the retail spaces being so beautiful and so luxurious, because of the appreciation of refinement and sophistication. So it's a very important and essential market for us. We're a long-term company, so we continue to believe in China, continue to invest in China.
The views of some of our guests talking about what is happening with the luxury space broadly, globally, but with a China focus. And the China story continues around this space. It's fascinating. Tiffany in 2019, 1,200-foot big store in Shanghai. It's decided it's going to basically give back circa half of that, an indication of what is happening in this space right now, particularly in China, but more broadly. But China feels like it's the epicenter of the action. Just weakness after weakness, the consumer retrenching. It started in China. China never saw the luxury bounce back that we saw in the rest of the world post-COVID. And that it's been amazing to see just the fact that that has persisted. Everybody's been waiting. It never came. And then the downslope came.
Yeah, the store expansion is an interesting one that they're pulling back. By Anna, by comparison, Tiffany also just opened a similar kind of facility in New York. I'm curious how much of that is a bet on the U.S. consumer.
Let's talk about where these luxury names go. Another company that's been feeling the bite of the slowdown is Burberry. The British brand has now been relegated from the FTSE 100 after its market cap fell by a third over the past 3 months. Let's get more with Bloomberg's Deirdre Hipwell, who joins us here on set this morning. Good morning to you, Deirdre. So what on earth has been happening at Burberry? This feels like a long story.
Yes, nothing good, really. If you look at the past year, we've had 3 profit warnings. The CEO has gone, the dividend's been suspended, and, you know, the latest indignity is being demoted from the FTSE 100, which, of course, is where they've been for the last 15 years. So they are facing a very difficult situation, as is their new CEO, Joshua Schulman.
Well, speaking of that new CEO, one of his criticisms is he's trying to appeal to a mass market when he is indeed leading a luxury company. How's he doing?
Well, I think what he's going to have to decide is, does Burberry want to keep persisting with the strategy of elevation, as they call it, trying to enter the elite super luxury ranks, become the LVMH of Britain, shall we say. But that's something they've been trying to do for the past decade, and they've gone through 4 CEOs and 3 creative designers. So he's going to have to consider, is that a strategy they still want to pursue?
Yeah.
Or is he going to row it back a bit?
Is Burberry a luxury company, or is it a company that sells coats?
I think it's probably what you'd call an elevated luxury company at this moment. They certainly have done very well in outerwear. That's something that always performs well for them. I think what's gone wrong in the last 2 years is they put in too much of what you might call the fashion overlay, the fashion forward type of designs, and then they pushed pricing up too high. So they turned off their core customer, and then they didn't have enough new customers to compensate for that. So I think there's definitely a rebalancing. It was already underway under the previous CEO, Jonathan Ackroyd, but of course it wasn't moving quickly enough,
Yep.
so they've brought in a new broom.
Yeah, I mean, coats make sense. We get a lot of rain, so, it would seem to fit the profile. But this isn't... Those things are specific to Burberry. You set that out clearly, Deirdre. But the slowdown in luxury, as we were just discussing around Tiffany and other names, isn't unique to Burberry. So where else are you watching?
Absolutely not. It has been very tough in luxury, and I think it's not necessarily going to improve anytime soon. I think everyone is struggling, but that's when it comes down to, and certainly investors will be looking at the company execution and strategy. And what we've seen is the companies that are doing better, the likes of Hermes, are the super luxury whose customer base is very wealthy and can still afford to buy the luxury items that they want. But for the others, it's going to be a lot tougher, and I think they're going to have to figure out how they're going to chart their way through these murky waters.
Deirdre, we're going to leave it there. Thank you very much indeed. We assume that the being kicked out of the FTSE 100 is a bad thing. So it's really... So the FT's picked up on this recently. Rob Arnott's been talking about it as well. He's launched an ETF fund that basically is designed... This is over in the States, designed to pick up on the companies that have been kicked out of indexes, because apparently they outperform over the medium term. And it's interesting, so we've got Rob on the show on Monday, which I'm really looking forward to get his take on all of this, Monday, Tuesday next week. The Lex column has scanned the numbers on this. Discretionary index deletions outperformed the index by 15% on average 6 months after leaving. British Land and Hiscox, which are going to be coming back in again, are the real kind of poster child of this kind of trade. But it's interesting. We kind of assume that this is the bad day. This is the bad day. Burberry gets ejected, but actually, in some ways, you front-run this trade. So the market will know this is going to be coming and therefore front-run it. So the shares is going to be pushed down as a result of that. But once you get kicked out, actually, that's the good thing. It's a bit like the fallen angels thing within the credit space.
Yes, and this is clearly a big enough thing. It's got its own ETF, a deletions ETF. So we'll certainly get that ready for the conversation next week. But Kriti, and some of that reporting that you're referencing there, Guy, making the point that, of course, because for all of those that are promoted, you'll get one NVIDIA and maybe a whole host of other frothy names that'll be back down as quickly as they rose.
I'm really liking that we're nerding out on rebalancing, because in the next 24 hours we're about to get one from over in the States with Apple and NVIDIA, which I think is a fascinating one. So one of the heavyweights potentially in the UK index now, potentially rebalancing some of the heavyweights in the US index as well. That's going to be a question that we're going to continue to explore in the next 24 hours. How does that shake out? How much of it is really Warren Buffett's fault in terms of how he is investing in two of the biggest names in really the world, not just the S&P 500? Coming up, we're going to dive into that macro conversation. Will the macro beta continue to see that trend gain? Ian Harnett from Absolute Strategy Research thinks that it absolutely will. We're going to speak to him next. Stick with us. This is Bloomberg. In the meantime, a quick check on these markets here. You are seeing a little bit of a rebound off the lows, but we're going to see how long that continues. There's a lot of moving factors, a lot of a political overhang. That conversation next. This is Bloomberg. This is the opening trader at 30 minutes into today's session. We were expecting a bigger pullback, and instead we're actually seeing the market open lower but bounce back off the lows, pairing some of those losses. We're going to see how that actually shakes out as we go into the rest of the trading day. In the meantime, we are getting some headlines coming out of German Finance Minister Christian Lindner speaking about the auto sector in a banking conference at the moment. He's basically saying he opposes exploring state aid for the auto sector. The context of this is crucial, given that Volkswagen is talking about closing down their key plant there and really pulling back on some of their EV strategy as well. They say their strategy of auto firms is up to their management. Those comments, again, coming from Christian Lindner. On the other side of that equation, Volkswagen is also talking about a union strike potentially coming in October. One of the labor negotiations are around the workday, a 4-day work week, Guy, being considered.
Absolutely shocking to hear Christian Lindner talking about being a fiscal hawk.
Yes, he's showing his political colours there.
I'm stunned by this news.
But there's a little divergence in his thinking versus other members of the coalition,
yes,
which is interesting. But he is somebody we listen to on this front. So, yeah, he's opposing exploring state aid for the auto sector. They'll be listening.
I'm sure they will. Let's talk about what is happening in the markets right now. A little bit of weakness coming into September. I say a little bit of weakness. It's obviously been a fairly bumpy week. Are we seeing some stabilisation today? We're a little on the downside, but we're really waiting for the payroll number. Where do we go from here? Let's try and answer that question. Ian Harnett, co-founder and chief investment strategist at Absolute Strategy Research, sitting around the table with us this morning. Nice to see you.
Good to see you too, Guy.
You're reasonably positive short-term on equities. Why?
So, I think that you can look at the environment that we've got now, and it's going to potentially be a very unusual one. We've moved from a multiples-driven market to an earnings-driven market, and those earnings expectations are still very strong, particularly in the United States. And it's really unusual to see a world where the Fed cuts at the same time as earnings are positive. You've basically got a double whammy there that's going to keep you pretty well supported. So until one of those two changes, until we have a very different narrative coming out of the Fed, or until we see those earnings numbers start to really tank down, then I think it's pretty difficult to be too bearish. Tactically, you can see the odd sell-off, as we've seen in August and, we're seeing now. But, I think it's just very difficult. And we've been constructive on this market all year.
Would big Fed cuts scare you then?
Historically, the larger the Fed cuts, the bigger the risks that you've had. But remember that of the 14 pivots that you've had since 1917, 12 of those were actually very bad for equities, and they were forced by really high unemployment or some kind of financial crisis.
So a 50 basis point cut would make you nervous from the Fed?
50 basis points, I think, would be surprising. It seems to me as though there's what I would call a Basel consensus towards 25 basis points, and I think that you'll see that probably from the US, potentially from the ECB next week, and then, from the Bank of England as well.
Does it seem to you, Ian, that there is anything in the jobs report or potentially in CPI that could prompt them to do 50? Because there's a lot... We always go to this sort of conversation about the possibility of 50, and I'm not sure... And expectation has built since the jolts and the Beige Book yesterday, but not by much.
Yeah, not by much. Clearly those jolts numbers were pretty weak. Remember that one of the things we need to focus on there is the government side. The bulk of that employment growth that we've seen since the start of 2023, 2024 has actually been in education, health and government employment. So actually those government jolts numbers coming down was really, for me, the things that was the interesting thing there. Ironically, if you look at what the claims numbers have done in the last 6 months, they would actually be suggesting that the unemployment numbers might come down for the next couple of months. And this is another reason for thinking that perhaps that 50 basis point cut is a bit too optimistic. Bearing in mind that the market itself is looking for a cut, a reduction in unemployment from 4.3 to 4.2 tomorrow.
Yeah, so if you're fairly optimistic about equities, do you have to take a view that the market is not going to get spooked again, like it was in August, by BOJ hiking? Because we've been reading quite a bit this morning from colleagues talking about the market underpricing the risk of a hike at a time when we're waiting for US data. Makes people feel nervous, perhaps.
Well, remember that the comment was not now about that Japanese rate hike. You're certainly seeing, we certainly see that you feel that you're seeing some increasing wage pressures, some stabilisation there. Just think about how long we've waited to lose that deflationary bias in Japan. That normalisation, think of it more of a normalisation. That is going to change how things work. But, so I don't think we should get spooked by that, and I don't think we'll necessarily be spooked by those, CPI numbers next week. Looks as though that exported deflationary pressure coming out of China is really making a lot of central bankers look like heroes, and that they'll take advantage of that. But again, that'll be another reason why I think they'll err on the side of caution rather than erring on the side of being a more drastic move, because those services numbers aren't really moving as rapidly, aren't really coming down particularly rapidly.
So I think what's confusing for a lot of investors and economists and even retail traders around the world is you're talking about the slowdown, and you see it in the economic data. The Beige Book was very doom and gloomy, as we discussed. But then you look at the earnings picture, and yes, there's a slowdown there, but the margins are still growing, and the consumers are still able to digest it. How does the Fed respond?
And I think, Kriti, that's the absolute essence of it. So we call this an uneasy equilibrium. It's very unstable. You've got this balance between those earnings numbers and the economic surprises, which for the last 3 months have been really very weak in the United States, particularly on a nominal basis. So, the ability of the corporate sector to eke out these margin gains, particularly for large cap companies. We've seen some pressure on smaller cap margins as, the supply chains have been put under pressure. It's how that plays out over the next 6 months that will be critical here.
So let me argue my exact opposite point, if I can. This is the perks of being a journalist. The flip side of that argument is that you're already seeing layoffs in a lot of the sector that is increasing the margins. And the only reason the margins are able to increase is because American consumers specifically, you're not seeing other parts of the world, are able to digest it. But there are signs that that's ending. And you see that in auto loan delinquencies. You're seeing that in the savings rate. Is there a time frame, you said the next 6 months, where we can see that become more pronounced?
Well, I think the key to this, and I think you've highlighted exactly where the issue is, which is that we've seen non-bank financials provide credit to both corporates and to households this sector. So to the degree that we start to see those non-banks pulling back, and you see some of these buy now, pay later, type companies having more stress in their delinquencies. And we saw that, the delinquencies, particularly for small lenders, increased very sharply recently. The stress will actually come on those financials, the smaller financials, rather than the consumer first, would be our guess. For now, that wealth effect for the consumer, plus the fact that inflation's coming down, allowing real incomes to rise, provides a pretty healthy support.
So you brought us lots of charts this morning. So I see your charts, and I raise you this chart, which is NVIDIA versus the S&P.
Yeah.
NVIDIA has front-run the S&P over the last year. You can see it really quite clearly. NVIDIA goes down, market goes down. NVIDIA goes up, markets goes up. NVIDIA has detached on the downside from the S&P. Should that be something that I pay attention to? How important is NVIDIA in your world right now?
So I think one of the things that we've flagged over the last year is that NVIDIA has lost, I think, 50% of its market cap, I think 13 times in the last 20 years, Guy. It is a highly cyclical stock. All this talk about it, so let's not lose sight of that. Those cyclicals now have actually sold off very aggressively. We're actually looking for a bounce back in cyclicality over the next 3 to 6 months. And from that point of view, probably we may have seen the worst of this. But remember that the earnings are spreading out, and that's one of the things that our strategy team has been highlighting. The earnings.
So I can pay less attention to NVIDIA because NVIDIA earnings have become super important for this market.
Well, they were super important for about a day and a half. And then what did we then what did we focus on? We focused on the PCE numbers on Friday. Yeah. So we still see this as a macro-driven market, and in our work we find 80% of total returns are actually being driven by macro factors, not micro-alpha.
But this is something, this trend that Guy's talking about, this kind of division between NVIDIA and the S&P 500, is something we've seen in Apple in previous iterations. We paid attention to Apple because it was a consumer story, and I'm curious, I know you say that we only pay attention to it for a day and a half, but isn't this a financial conditions reflection mechanism on the Fed? Doesn't that factor in?
So, the closest link that you have there is, say, the link between NVIDIA and Bitcoin, and that being a link to overall liquidity conditions in the market. Looking at the correlation of, those two assets and the expanded financial liquidity environment from the Fed plus TGA and reverse repos, those have worked quite nicely. So if anything, that's telling you, that pullback is already telling you that, we've seen some tightening in liquidity short term.
Are you connecting the Fed to Bitcoin?
Oh, absolutely. Have you not seen that chart? Oh.
I've seen it, but I guess...
It's a liquidity proxy. Yeah, and these things are liquidity proxy, particularly where they're very highly retail-driven. Then you're seeing those kind of liquidity trends play out. Now, clearly, there's been some, market factors and, fundamental factors on that, the disappointment. And one of the things that we've emphasised on NVIDIA is that the CapEx spend of the buyers of NVIDIA's products don't add up to the sales that NVIDIA are talking about. So we've been raising that with clients. So there's some disconnect there. There is hype, but that hype is about liquidity. And so that's why I would link those things.
Yeah, that takes us to the comments we got from some of the analysts on Monday that really sank the share price of NVIDIA around, when are we going to see this showing up in other companies outside some of these big tech names? But I want to go away from tech because obviously NVIDIA has been important to the US. Cars, for as long as anyone can remember, have been important to Germany. So bringing it back to Europe, we were talking about Christian Lindner, the finance minister in Germany. He's been saying that he does not want to explore, he opposes exploring state aid for the auto sector. The strategy of auto firms is up to their management. What is the investment case? Is there any investment case you can come up with for German autos at this point?
Well, I think the valuation case is the best case, and the degree to which we're looking, let's link a few of these ideas, Anna, which is that actually remember the other thing that's been important for Europe has been its ability to export to China. So, that weakness of China, the continued overproduction that our team are focused on in terms of that Chinese export-driven model coming back into play and the manufacturing-driven model, that's the thing that's actually holding things back at the current time. We see, still a major weakness in China. So for now, I think it'll be difficult to see those German exporters, really come back. But, at the same time, what we need is a bit more dollar strength, euro weakness to help them out.
OK, and, we were seeing the PBOC talking about the possibility, space for triple R cuts. You never know if they'll use that tool or some other tool to try and do something
at some stage, they need to break out of this, the problems that they have in the housing market.
OK, thanks so much, Ian. Really good to see you. Thanks for joining us. Ian Harnett, co-founder and chief investment strategist at Absolute Strategy Research. Coming up on the programme, we turn our attention to the energy sector. OPEC Plus is considering delaying a planned boost to oil in oil production. We discuss the factors prompting a rethink among members. Next, we've certainly seen a big retreat in the oil price this week. We'll get to that shortly. This is Bloomberg.
Welcome back to the opening trade. About 46 minutes into today's session, seeing a little bit of a turnaround story when it comes to these equity markets. We opened in the red across the indexes and bounced off the lows. We are now in positive territory, but not a major rally there. Let's see how that shakes out as we go into the rest of the trading day and certainly into the U.S. as well. In the meantime, we want to get a quick check on what's going on in the commodity space. So given all the volatility we've seen in oil prices this week, OPEC Plus delegates have told Bloomberg that they're close to an agreement on delaying a planned increase in oil production. It comes after Brent crude, as I mentioned, slumping this week to its lowest level in 14 months, erasing all of its gains throughout the week. Let's bring in Anthony DiPaolo, Bloomberg's Middle East energy markets reporter, to walk us through what's actually going on in the space. Anthony, walk us through the ups and downs of this week. Why is it so turbulent right now?
Yeah, good morning. Well, we've had a lot of movement. First of all, the underpinning thing in the market these days is that concern over demand, that there's not going to be enough demand to support prices and to soak up all the oil that's coming in the market. On top of that, you put in the OPEC Plus issue, which is that OPEC Plus was set to bring back some of those barrels that they'd taken off the market starting from October. That was a group of countries in the OPEC Plus producers group that had made voluntary cuts, and they wanted to start unwinding those and getting those barrels back on the market. That comes at a time when the market just doesn't seem to be ready to take those extra barrels. So what we're understanding is that the OPEC Plus ministers are taking that into consideration and are looking to delay this increase in oil production, so push that back potentially through October, potentially later in the year. We're waiting to hear what those countries say, potentially some announcements today or in the coming days about what they might do going forward about that increase in October.
OK, so that's what we might hear from OPEC then, Anthony. I mean, what do you make of the fact that we got these lines yesterday? Our reporting made this clear yesterday. Did it put a floor under oil? I mean, we do see oil prices bouncing a little this morning. Didn't send them back from where they've come from, though, back up to where they've come from. What did you make of the market's response to this kind of line? It seemed to perhaps underscore the concerns around growth, the China and the US economic concerns.
Yeah, well, we had a lot of reports from analysts from Goldman, from Citi, talking about prices even, pressuring 70. So Brent going below 70. We already did see WTI drop below 70 this week, but even Brent and Citi talking about even more trading pressure that could drive it close to 60. So with that increase, we were probably headed for much lower prices because that would lead into a surplus towards the tail end of this year. Potentially, we're looking at a surplus even into next year as well, too. So that's kind of that pressure on the oil price that's keeping it really from bouncing back, as you said, to where we were before. It's that concern over demand. Weakness in China. We saw some weakish data on the manufacturing PMI from the U.S. earlier, so that tends to reawaken some of those recession concerns in the United States. So it's really that concern about demand weakness that keeps a lid on those prices.
And people are paying attention to the connection with what is happening with iron ore at the moment and the weakness we're seeing there, and whether or not that is a leading indicator for maybe the broader oil market as well. Anthony, great stuff. Thank you very much indeed for the updates. Anthony DePaolo joining us out of Dubai. Let's talk about the setup as we head towards the big number of the week. That, of course, is the payroll number. We're going to get some ADP data today. We're going to get some claims data, but we're really waiting for the non-farm payroll number, which will drop tomorrow. Michael Masika, Bloomberg senior reporter covering equity markets and strategy, joins us now. Feels nervous. Everybody's a bit on edge going into this number. Volatility remains high. VIX is at 20. Give us a sense of kind of how we're set up. What are you hearing?
Guy, the first thing I would say is there is a sense of caution from pretty much everyone, but there is no sense of either panic or think that this bull market has come to an end right now. People are reducing exposure. You have like hedge funds selling a bit of tech, reducing their exposure to like credit trades. So we see kind of a lot of that. But overall, it's just caution rather than pessimism, I'd say.
What does the positioning look like going specifically into tomorrow? It looks like the options market is doing something.
It's doing something. We've seen a lot of reduction in risk in CTAs. They've been starting selling, but not from asset managers. Asset managers are max long, especially on the S&P 500, I think, as long as they've ever been. And this has moved a bit in August, but came back right up to max long. So it's kind of there's a mix of you have fast money exiting the market, but coming back very quickly as well. Yeah. So buying dips, selling tops, and you've got long-only managers and asset managers like longer-time investors that are still very, very long the market and very long tech.
Yes, long the market, long tech. And so for those people, are they not worried when they see Nvidia down by 9% in one session on not much? Because we've got a couple of analysts who pointed out things that people really kind of knew, and the poster child for AI collapsed in a day. I mean, you talk about people are not panicked. It's just a little bit of caution. I suppose it depends how long tech you are.
Yes, definitely. But I mean, the thing is, a lot of people are. Like if you compare the weight of tech into the benchmark and how risk managers and asset managers have to construct their portfolio, they can't be as long tech as the benchmark is. So technically, let's say it's a bit less of a problem. It's still a problem. If you look at the S&P and Nvidia, it's been literally driving the market the whole year. So
I stole this chart from you, by the way. We've been putting it up all morning.
But I think as some funds start to reduce their exposure to that specific stock, and that's what's been happening lately, there'll be less of an impact on the broader market.
Volatility has a memory.
Yeah.
Talk us through that and the impact of the VIX at 20 and how risk is changing if volatility stays high.
So what happened is, like, when you have like a big spike in volatility like we had in August, it's usually followed by, other spikes. Not necessarily as high, not necessarily higher, but you get some sense of market stress for a period of time. And that's what we're seeing here. This is impacted by market makers and how people are positioned in options, like mostly. And you see those are technical spikes, but they have an impact on the market. And then you see market falling a little bit more. Is this like a warning that things are going to collapse, or like we're going to have like a big bear market? Not necessarily. And most of the time it isn't. Now, having said that, we are in a month where you have a lot of things that are going against the market. So we've got the Fed meeting that everyone is waiting for. We've got the job data everyone is waiting for. Job data until now has been like going, pretty bad, I'd say. I mean, if you look at JOLTS yesterday, the openings will be like, lowest in a while now. So it starts to show that the economy is slowing down, really slowing down. It's still a soft landing at the minute, but all that is bringing caution into the markets. Outside of that, you have the Fed meeting in next 10 days or 2 weeks. And you also have the blackout period that's going to start. Buybacks have been a very, very strong support of the market, especially in August, and it helped the market coming back to high. The blackout period, like I think end of next week, 50% of S&P companies will be in this blackout period. So that's another support of the market that's going to vanish. So you have a September month, which is really tricky. And it's part of the reason why September is always like a tricky seasonality. It's a bad month for equity markets generally.
You mentioned that key buybacks piece. I think I read somewhere that the August buybacks from S&P 500 companies is up 19% or something like that on relative to its average. It's massive, but you talked a little bit about the VIX and the options positioning there as well. What are the signs from a normal market panic, a lot going on as you outlined, to something like a 2018 fall repeat of a Volmageddon 2.0? At what point do we get to that level of panic?
I think we are still very far from it. I mean, even when you look at the spike that we had in August, it was so technical and so quickly. It came back so quickly. I think the market has, adjustments. It adjusts very much quicker than it used to, and this is what we're seeing also right now. So you got that vol spikes. You got a market that is really shaky. The problem is, like, everyone is really focused on growth at the minute, and what's going to happen with the U.S. growth and with the U.S. job market, and what the Fed will do. And we're kind of in a tough spot where if it's too hot, that's not good. If it's too cold, it's not good. It needs to be like in line.
Sounds like a story someone once told. Michael, thank you very much. Bloomberg's Michael Masika with the latest on the markets. Fantastic to have you on set with us this morning. Lots coming up today. We've got a gilt auction, US data in focus around the jobs market, as always, as it is Thursday. We also have the former president and wannabe president again, Trump, speaking later on about his economic agenda. So we'll certainly focus in on that. That's it for this hour of programming. Have a good day, everybody. This is Bloomberg.